Welcome in, folks. It's a buy one, get two free in this one here today. 3 videos for me to react to in this one. Looking forward to this one here today, folks, okay? First one up here. Stocks won't see a sustainable rally without clarity on inflation. Here, these two gentlemen speak about kind of where they see the market going, where they see stocks going here in the shorter term. Then we're going to listen to the professor, Jeremy Siegel, the professor. 3 hours ago, he was just speaking about what to expect from the Fed's meeting, what he thinks that means for the markets and whatnot. We'd love to hear kind of his opinion and share my opinion, okay? And last thing is, Jim Cramer is going to break down Amazon Q1 earnings as the stock dips. Hear what Cramer has to say in regards to Amazon. This should be an interesting one. And obviously, Amazon's the main position I'm buying this year as far as a big company. So, you know, let's call it super large. Last year was Meta. This year it's Amazon, right? And could be actually Tesla as this year goes along too. But yeah, looking forward to hearing what he has to say and just kind of share my opinion. So thanks everybody for being here as always. Thank you for being subscribed. 26,100 plus subscribers now on the channel. Everybody in the Patreon squad, I just made my moves and posted those up an hour ago in there. If you're looking to join us in the Patreon, get in there ASAP because the $10 tier is about to go bye-bye. So if you want to access the moves and see what I'm making in the market and what's going on there, definitely check that out. There will be pinned comment down there. And once again, this is about to go bye-bye. So if you want to get in for that tier, get in ASAP. This is the only tier that will be left once this one goes bye-bye here very shortly. So do keep that in mind. Alrighty, guys, let's get into this.
Tell me kind of how you read the tea leaves right now.
No, in 2022 was a year where risk capital went to the sidelines, and I don't think it's coming back. But at the same time, if you look at tech, the big money-making tech companies are the ones that are bringing the market back. And collectively, just in the last 4 months, the top decile of tech companies, the largest tech companies, are up $1.7 trillion. I mean, that's pretty much the rise in the market. They lost $3.5 trillion last year, so it's not like they're back to where they were before the market started its downturn.
That's true.
But I think the comeback has been almost exclusively in money-making big tech companies. This isn't a rally that's carrying all tech along with it.
Right, and that is telling to you, Aswath, because you're simply looking for signs that the rally could be sustainable, and you're not seeing that yet, are you?
No, and I think until we get some sense of direction on the inflation and the economy, you're not going to get a rally that is sustainable and broad-based. And I think we still have an incredible amount of uncertainty as to where inflation is going and how this economy is going to play out.
Yeah.
Let me check the Truflation numbers literally right now, and let's see what Truflation has us at for a current CPI. Oh, can you guess the number? Can you guess the number, folks? Okay, I'll put it on the big screen here. Alrighty, this is the Truflation number. They got us at 3.96% right now. 3.96%. So, yeah, we'll see what happens. Hopefully the government numbers get us under 4. Let's call it over the next, I would say, 2 months. That would be nice.
I'll circle back to it. I remember when we talked, I think, was it Netflix or not Netflix? Because I know you bought most of Mama, as we now call them.
Not Netflix. Everything else but Netflix.
That's everything but Netflix was the trade. All right, Chris, let me turn to you.
Dang, that's a diss. That's a diss at Netflix. Come on, man. Wow.
Because obviously I've seen the work that you're doing as well, trying to figure out kind of where the strength and weakness is in this market. And it sounds like you largely agree about the narrowness of the leadership.
Yeah, hi, Kelly. Thanks for having me on. Yeah, it's, there's 7 stocks driving 80% of the gains. The overall narrowness of the breadth in the market, to me, is not
7 stocks pushing 80% of the gains in the market. That's incredible.
Encouraging sign. We have a situation where, the market's focused on earnings over the next week and in the past week, but then it's going to shift back to the macro with the Fed meeting and other inflation data coming up. And, inflation's running hot and is sticky. And ultimately, we think the Fed's going to be higher for longer. So the narrowness is, to me, not a good sign for the broader market.
Where would you, Chris, if you had to then kind of rule out certain areas that you think are overvalued, like tech, are there any that are fairly or even undervalued?
So one of the things we've been focused on is earnings quality within tech. So one of the concerning signs and signals to us within tech is they're laying folks off, and some of the mega cap tech companies have been extending their depreciation schedules, which has boosted earnings, we think, 8 to 10%.
Wow.
Most notably Google, or I should say Alphabet, in this most recent quarter. So within tech, given our defensive nature and bearishness of the overall market, we'd be in software type names, large cap names, like the Microsofts of the world that have posted strong results, but you got to be very careful. It's not going forward from here. I don't think it's just going to be buy all big cap tech and make money.
This is interesting, and earnings quality and concerns about it are really bubbling up this quarter. So, Chris, let me make sure people understand what you're saying. You say the quality of earnings is lowest at Alphabet among some of the mega cap tech and media names because they extended the depreciable life for server and network equipment for a second time, shifting some expenses about stock-based comp. So is that the only company where you pick up on these concerns, or do you think there's a larger problem here?
I think there's a larger problem. I mean, Alphabet did it most recently, but the company started to do this in 2020. Meta's done it 3 times. Microsoft's even done it. And we don't see it in other areas of the market, right? So you ask yourself, why now? It's not as if everyone's sitting around the table thinking about how long they should depreciate their server equipment when they have bigger problems to deal with. So it's curious that you always ask yourself, why now? And the fact that they're doing it again, to me, is not an encouraging signal in the future business, of the future fundamentals of the business.
Sure. Aswath, it reminds me of something Mike Darda highlighted earlier this year as well, that we've had operating earnings from the S&P kind of 25% higher than reported earnings across the economy. And
by the way, that's shocking. Do you know what I just saw? That's shocking. Absolutely shocking here. Check out specifically Mr. Softy here, the chart of Mr. Softy. I was amazed at that. Where did they show it? I swear it was right around here, wasn't it?
The future fundamentals of the business.
Sure. Aswath, it reminds me of something Mike...
There it is. I mean, you get another up week or two in Microsoft, this baby's at an all-time high. Literally, you get 1 or 2 weeks of an upward market, and this baby's at an all-time high. Who would have thought that, man? That's amazing.
Darda highlighted earlier this year as well that we've had operating earnings from the S&P kind of 25% higher than reported earnings across the economy. And a situation that we often tend to see at turning points when people are kind of like Wile E. Coyote, they're trying to pretend like we're not going over a cliff here.
There is a disconnect between what's happening in earnings and what we're supposedly seeing in the economy, though we still don't see the tangible evidence that we're going to head into a recession. And I think you can see it even the aggregate earnings forecast for the index is there's almost been no dent in it over the last 18 months in spite of all of the talk of how the economy is heading towards a cliff. So either the analysts forecasting earnings are wrong or the macroeconomists are forecasting that the economy is weakening is wrong. But I think that, but one thing to keep in mind with these big tech companies is even as they report higher earnings, they're also being very clear that revenue growth is now down to single digits. These are not double-digit growth companies anymore.
Interesting. Yeah, well... When he says not anymore, I think it's very important to remember that they could be again in the future. It's just we're in obviously a much weaker environment in the business climate right now. So let's say you own a company and they're growing 7% revenues right now. It doesn't necessarily mean they're going to grow 7% revenues forever. They could see a reacceleration if the overall business landscape could get into a better place. And so I think that's just something worth mentioning there, okay? All right, time to listen to Professor Jeremy Siegel from 3 hours ago and share my opinion on this one.
At the University of Pennsylvania's Wharton School of Business, whenever you're on, I think, Professor, that what you said last time, many times I'm starting to see those things happen. And I think especially about the economy recently, the Fed, you've been outspoken that inflation was probably already in a downward trend and that the economy was already cooling off, so they didn't have to do any more. Let me ask you, throw one wrench into that. When we had this banking issue in the last month, I've heard people say that the Fed reversed months and months of balance sheet reduction and tightening and basically threw it all back out there just to stem that situation. And you've talked about M2 slowing. Did we relight the monetary fire with Silicon Valley Bank? Does that concern you?
No, that doesn't. And by the way, that discount window borrowing, I think over 50% has now been paid back. Discount window borrowing isn't in M2. And on Tuesday, just last Tuesday, we got M2, and it was another decline. We've now had a year of decline. In fact, it's the biggest decline in 85 years for that broad money supply data. So, I think that's still got to be a concern for the Fed. Now, next week, what I'm looking for, I think there's two things I'm looking for. First of all, whether your good friend Austin Goolsbee is going to dissent or not, Joe, because he's talked about keeping rates the same. But I think the rates are definitely going to go up a quarter point. What I'm looking at is the statement that goes with it. I'm looking at, is Chairman Powell going to say it is likely that we pause now and assess what the economy is going to do? Or does he really say, oh, and there's more work to be done on inflation? And I think the tone on that balance is going to be very critical to how the market is going to move next week.
It's interesting. I really hate to say that Austin seems really reasonable and like a voice of reason, but I think that's right. But that would be something if he were to dissent. Are you expecting that?
Yeah.
I don't expect that.
There has not been a dissent.
One and done, huh?
Well, I mean, there's not been a dissent for almost a year and a half at the Fed, which I found remarkable during one of the most tumultuous monetary periods in history, that you would not have opinions one way or the other. It's just like everyone falls in line, nodding their head on what Chairman Powell does. I would like to see some independence here. So I'm rooting for Austin to say, hey, I think we can stop now and not get a quarter point. I mean, it's mostly just a statement. Hey, I'm not going to go with the crowd 100% of the time the way everyone has for almost all of Powell's tenure.
Yeah, that's fair. And he does bring up a good point about, if you think about it, obviously the Fed has been the topic of conversation for pretty much a year and a half now at this point in time, right? And, for there to be no major disagreements inside the Fed, right? No major disagreements. That is interesting. That is kind of played out like that. And you could say maybe they want to give the illusion that everybody's in agreement, or maybe just everybody agrees. And to be fair, I mean, could you have said anything other than just keep raising rates over the past year or so? I think now is finally a time period where you could have different opinions on keep raising rates, right? Because if we're now having, real inflation lower than the Fed funds rate, I think this is actually a time period where you could have differing opinions. But I mean, when you had such low unemployment and you had inflation where it is, I mean, people are just going to say, take up rates. And so I'm actually not surprised there hasn't really been, major disagreement there. Okay. All right. Kramer on Amazon. I'll try to keep my cool on this one.
Shortly after yesterday's close, and that did spark an initial double-digit rally. Those gains, though, were erased on the company's warning of a slowdown in cloud growth. This is what the CFO had to say about AWS on the call.
Given the ongoing economic uncertainty, customers of all sizes and all industries continue to look for cost savings across their businesses, similar to what you've seen us doing at Amazon. As expected, customers continue to evaluate ways to optimize their cloud spending in response to these tough economic conditions in the first quarter. And we are seeing these optimizations continue into the second quarter, with April revenue growth rates about 500 basis points lower than what we saw in Q1.
And that was the line, Jim. That's what did it.
Yeah, and we got to flesh it out here because, first of all, there's so many good things that happened this quarter. We're seeing the beginning of the rationalization of the workforce being completely ignored over that one line of 500 basis points, taking the growth from 16% down to 11. It was as high as, you can say, as 32 18 months ago. Now, they are trying to say, listen, it's bottoming. And it's bottoming in part because of all the really exciting things that are going to happen with Chat, GPT, with generative AI. I have to tell you, I'm with them. I think that there are a lot of people who say that they lost a lot of share. I'm not buying that. There are a lot of people who say this is the beginning of the end of the cloud. Given the fact that 90% of companies are still on premises, I think there's a lot of business. And David, Olsavsky...
Kramer took that 90% number from the conference call because they mentioned that on the conference call, right? And they believe, obviously, Andy Jassy sounds like he believes that's going to flip over time, right? And so... AWS is still, believe it or not, it sounds like it's very early innings from where it could be in 10 and 20 years from now. And that's pretty wild to think about because you think about how big AWS is today. And I think it's still early innings in this game is quite interesting.
Straight guy. Mm-hmm. He's a straight guy. Yep. And they're very confident. They are not, and no panic button there.
Yep.
They really think business is fine.
I heard a relatively positive take on it as
something I heard on the conference call that I loved was and this goes into the long-term thinking mindset, right? Is Andy Jassy and the team, they were talking about how they focus on customer relationships that are going to last way beyond their time period at the company. And so it's such a refreshing thing to hear, because I'm telling you, like, 98% of executives out there are they're just focused on whatever's happening in the very, very short term, because they're not going to be at that company. They don't really care about it long term. But Bezos has such a long-term focus at that company, and he's done such an amazing job of instilling in the culture. And who knows if that'll still be the culture of Amazon 20, 30 years from now. But it is today that they're focused on client relationships that go way beyond their time period at the company. Andy Jassy, who knows? Is he going to be at the company 3 more years, 5 more years, 10 more years? I don't know. But he's focused on building such strong customer relationships that last way beyond his tenure at the company. And that's something I just find so refreshing. It just makes me such a happy shareholder and such a happy person to be buying the stock this entire year, because I just look at it, I'm just like, that's the mentality I need in a company. Somebody that's really focused on the long-term game here, and not just focused on trying to grab whatever they can from, their customers of AWS right now. They're working with their customers to bring down costs as low as possible right now. And it hurts them in the short term as far as their revenue growth, but it helps them massively long term, building actually sustainable, great relationships. And their customers won't forget that. And so these are just things I think about that I think are very impactful and matter in a significant way.
You did? Yeah, on AWS. First of all, they came out of the quarter roughly 11.
By doing your customers right like that, by doing your clients right, makes it much less probable they're going to go somewhere else and do something else, right? It's like you go to the pizza restaurant, your favorite pizza restaurant, and they mess up your pizza. They could just say, tough. Or they could just make you a whole new pizza, right? And keep you as a customer. If they say tough, well, I don't know. That might not be your favorite pizza spot anymore. You might go somewhere else, right? This is business, man. Business is a simple game. Keep your customers happy, do right by your customers, and you'll be rewarded over time. It's always been that way. It always will be that way.
% growth rate.
Right. The April was 11. The March was better.
But also it had to do with comps and the idea that Azure has a much more Fortune 500 customer base.
Correct.
And CFOs there actually were earlier to start cutting. And if you remember, there was a point at which Azure was decelerating in growth.
Right.
And now it's reaccelerating.
2 quarters ago.
In part because they were already seeing the cuts from CFOs. However, Amazon, the biggest, has a lot more customers who are smaller in some way or VC related. And they've been later to cut costs. They won't comp those until the August quarter. Let's call it August. And so you're just a little later with Amazon in terms of the reacceleration.
We're going to be talking about a bunch of smaller public, admittedly. They're literally the equivalent of .coms, frankly, when I look at it. I'm talking about Pinterest and Snap. And David's just 100% right. This is just guys are just cutting back now. But by the way, can we give them something here? They recognize that they spent way too much. They are rationalizing every one of their businesses, whether it be grocery, whether it be, just simple one day, same day. And I think that we forget that they have a lot of firepower if they just cut fat.
Right.
And they're doing it. They got no credit for it because all anyone talked about is 500 basis
You're referring to operating margins in North America. 1-2 is a reversal, and you're saying that's the cost-cutting.
That's what you should be focused on, for heaven's sake. I mean, this company has the possibility of making a huge amount of money away from it. Amazon ads are very good. They're really starting to make some money on Prime. They're starting to make money when you go to your TV set and you don't hit up Paramount Plus, you hit up the program, and it goes right to Amazon. I felt that they were on their game on everything but this, and they are saying, line in the sand, they're going to do 10%. That Amazon Web Service is not going to go much lower.
Meanwhile, of course, as you know, the stock. Thank you. The stock was up a lot,
right.
And then they had the call, and then investors started to focus on the growth rate at AWS, and it reversed.
Right. And JP Morgan has a similar call to you, and I'm with JP Morgan.
You are?
Yes, I really am.
Yeah.
I think. Look, I've been very critical of these guys, waiting for them to finally start being more rational about spend. Jassy, religion.
The retail business still doesn't make any money.
Well, but they are at least not going to they're not throwing it in the chimney anymore. They're starting to really evaluate projects that don't make money. I wish that Alphabet would do this. And by the way, AI, I do believe. I mean, look, yes, Microsoft has leaped ahead, but when Alexa listens to your every move and starts programming your stuff because you're talking to your wife, I think it's AI.
Amazon designing its own chips. I mean, that's another thing. Like everybody else now. Tesla has its own chips. Apple's got its own chips. Meta's got its own chips. Everybody, ARM does it for everybody.
Right.
But
NVIDIA's got 45,000 chip. I mean, that's how much it costs.
Yeah.
We haven't even mentioned how great Pat Gelsinger, nice as he's been.
Oh man, I'm kind of disappointed. Kramer didn't say anything to get me going there. Okay, so Amazon, one of the very few stocks in the market that every dip's a buying opportunity. One of the very few stocks. There's there aren't that many stocks in the market that it's like every dip you ever get, any major dip you get in that stock, you take advantage, throw it in the filing cabinet and forget about it. Amazon's one of the very few companies. When you look at like how much growth still the e-commerce business has. Like when does the e-commerce business stop growing? 15, 20, 30, 50 years from now? Like I don't even know. It's so long in the future. Like it might be past my lifetime, to be honest, right? Like that's insane. AWS is still earlier innings in this game. I don't know if that's a third inning game or a fifth inning, but we're still in the earlier innings of AWS. That still has so much growth ahead of it over the coming years, right? The advertising business, obviously, right? They're spending a fortune on tech right now in Amazon Prime and things like that, which we'll see how that pays off over time. But obviously, they're very focused on spending there, and they just have the right DNA at that company to focus on the next big opportunities and focus on the long term, which is something I just appreciate in a massive way. And so Amazon's one of the very few stocks that every dip's a buy, every single dip's a buy. And, it's hard to go wrong in that one over a 3, 5, 10-year span, and so I expect to make very nice returns in that one over time. I might even do a video going into all my Amazon projections over the next 5 years. If you're interested in something like that, let me know in the comment section. I can maybe do something like that on the main channel, or even this channel, maybe even potentially, where I go into all my projections for my ultra bearish case, my bearish case, my base case, my bull case, and my ultra bull case over the next 5 years. So yeah, let me know if you're interested in something like that. I appreciate everybody. Thanks so much for joining me, folks. Make sure you get in that Patreon today, folks. It is going to be very important if you want to actually access and see the moves I'm up to in the market in the Patreon portfolio, because once again, that $10 tier is going bye-bye very shortly here. So much love. Appreciate y'all, and have a great day.